Hello and good evening. This is Doc Severson for the ReadySetCrypto OMNIA newsletter market update for Wednesday, the 8th of January. Apparently, yesterday's report was finished just a couple of minutes before the rocket attack from Iran over the border. And so that helped to drive Bitcoin versus US dollar up significantly in the last hour of trading. And then today, even higher than that. And we peaked out just about 8,500. Now, this is almost as much as the measured move here from the inverted head and shoulders, but not quite. So in other words, what I'm talking about is that this move here, this distance between the neckline to the bottom of the head pattern is just a little bit larger than the measured move that we've had. Now, there's no law that says that it must go to a certain level. It's more of just an approximation from how elastic this pattern is. So in other words, a larger, much more bearish pattern like this would really stoke up an incredible amount of bearish sentiment, and it would get unwound to the upside to much higher degree. This really isn't much of anything at all. And this is what I keep saying here is that we're just not getting that much movement right now. And it's hard for me to imagine that we have enough bearishness to unwind to the upside to cause this to really explode. I just don't see it right now. So we can wish and hope that this continues to happen. But unfortunately, until we get some volume in here, I just don't see this reversing. In fact, what I see this happening in the short term is maybe a revisit of this area. Even though, look, guys, I don't want to say that, but right now we have this weekly trend that keeps on plugging to the downside. And right now, this little shot to the upside, which is about the average swing length, is just setting up another lower high. So this morning I got in the Discord area and I said, you know what? Let's set up an out of the money. I think I talked about this the other day. Let's set up an out of the money vertical spread at the expected move. And so this morning, the expected move was about, about 1091, almost 1100 points. So when the price was around about 8,500 or so, I did an at the money straddle. And right now it's showing, I'm not going to calculate it right now. You guys can figure this out. But basically what you're doing is we're taking the price of the long option here, adding it to the long option here. That is an at the money straddle. And right now with the price at about 8,000, it is whatever it is. And that's the expected move. So the price I believe this morning was around 8,500. It was actually 8,301 when I calculated this. So I used the 8,500 strike. And I had about an 1,100 point move. So what I wanted to do was to set up a trade which is around in this area here. And so the advantage of this is when you set up an out of the money spread, it's less expensive. What we're doing is we're going long on the 7,500 put and going short. So we're going long first and then going short by selling to open the $7,000 put. And at the time, the 7,500 was going for about $194 midpoint, and this one was going for about $100. So if we bought this one at 194, if we sold this one at 100, the net debit would be about $94 per contract. About $94 per contract. So right now, it's a little bit different because the price is pulled down. So more than likely, this one is going to be more expensive than that. So if we sold it, we'd get the credit. The trade is already profitable. Now, I just got this email today from Deribit that they have created a position monitor. So what we can do with this guy is that we can, if we focus on the 30 Jan options, we can build this. And we're going to do 7,500 put. That's going to be, let's say, one contract. And we're going to go long on that. Okay, so this is the standard profit and loss graph of a long put option. So there's an initial debit, and if the price goes lower, there's unlimited profits to the downside as long as it stays above zero, right? So now let's add another option by adding the 7,000 put. So we're going to do this one short. And so what we have created now is a vertical spread position. So what we're looking at is the red line. Red line here is expiration. So if the price stays anywhere above 7,500 between now and the end of January, then this is our maximum loss, which was, when I set up the trade, $94. And now it's a bit more than that because the price has moved down. So this trade is understandably a little bit more expensive. So the green line is today's profit and loss. And this is the one thing that people have to understand about options is it's a variable thing. It's not linear. It's going to change with implied volatility, with time, with price as well too. But you can start to see if the price goes lower from here, the green line picks up and we're in a profitable trade. And it doesn't take that long before we're 100% profitable on this. So it doesn't have to move that far. And ultimately, we're looking at about a 4-to-1 reward to risk at the cost of probability. The probability when I looked at this was only about 19.5% probability of success. So if you have any interest at all in options, I recommend that you take a look at this. Let me give you the link for this guy. It is pb.deribit.com. pb.deribit.com. So expand your skills, play around with this a bit, and look at what happens when you create combination of option positions. So again, this is a out of the money put vertical spread. All right, guys, that is it for today's report. Thanks for listening, and we'll see you tomorrow night. Take care.